Hey everybody, it's Daniel here from FRS. Hope you're all doing well. So you might have seen it already on the headlines. The GDP numbers came out worse than expected. GDP numbers for Q1 prelim numbers came out minus 0.3% versus the expectation of 0.2%. We also, along with these numbers, had real consumer spending numbers coming at 1.8% better than 1.2% expected. We had also the PCE prices coming in higher than expected, 3.5% versus 3.1%. So basically hinting towards higher prices, higher inflation, but weaker GDP numbers. Along with that, we also had the ADP non-farm payroll employment change come in at 62K versus the 114,000, which was expected. And prior's number was also revised lower from 155K to 147K. So what do I take from all this information here? Well, first things first, the initial reaction in the stock market was we did see a sell-off. We saw a sell-off in stocks and bonds, but and that was in the morning at 8:30 a.m. Being here today at noon, we are seeing a rebound in the equity indices. Nasdaq being the strongest. We do have tech earnings, especially today. Meta and Microsoft reporting today. We are seeing a rebound and tech being the stronger index, followed by S&P 500, Dow Jones, and the Russell 2000. In terms of the bond market, we did see some selling and then a pick back up, being the shorter end, the 2-year bond, rallying up and the long end lagging behind. And that's basically causing the steepening in the yield curve. So overall, the reaction was initial knee-jerk down, fears of economic contraction, economy getting worse off, and the stagflation fear, where you have prices higher but growth is declining. Now, on the caveat, the biggest contributor to the weakness in the GDP numbers, which you might argue, okay, this is basically means that we're in a recession, or we can be in a recession if we get the next GDP report being negative as well. So if you get two consecutive GDP reports, 2 consecutive quarters being negative, then by definition that's a recession. So you got the first quarter being negative. But what is the contributing factor here? Obviously, you might be thinking it's the man heading the country, Trump, right? And if you're thinking that, you're on the right path there. So let's first break down and talk about the components that make up the GDP, and let's explain a little bit what's going on here. So personal consumption came down to 1.21%, down from 2.7%. So basically, almost more than half. But translating into annualized personal consumption print of 1.8%, which is higher than 1.2%, right? So the personal consumption there declining. It's still positive, but it has seen some sort of decline from the 2.7% level, which is basically telling to you that personal consumption is declining, obviously, because you've got the higher prices out there and you are having layoffs like we're seeing in the jobs numbers, the ADP numbers that came out today. Fixed investment, however, jumped to 1.34%, and this is up from minus 0.2%. So, okay, not too bad there in terms of fixed investment. So we're still getting some investments going on. Change in private inventory surged to 2.25% as expected on the pre-tariff restocking. This number was up from minus 0.84% drop last quarter and is expected to reverse in the coming quarters as inventories are sold off. Government spending was also negative, as we've been hearing, right? Minus 0.25%. They're spending less. Government's laying off certain employees as well, tightening things here. the first negative, this is basically the first negative print for Joe Biden's favorite plug to push GDP higher since 2022. And finally, most important, what caused the negative number in the GDP was the net trade, which was exports less imports. And what drove it was the significant high level of imports for the country, and less exports. So there was a whopping 4.83% hit to the final GDP number, a 5% swing from the plus 0.26% contribution in Q4. This was entirely result of soaring imports, of which gold was about half of that, which makes you think. A lot of countries out there accumulating a lot of gold, right? Another currency. Basically makes you think what's going on. This is more of an alarming sign when you're increasing the gold inventories, especially when you're seeing other countries out there, right, with the trade war against U.S. and China. Countries out there increasing their gold position because they want to move away from that US dollar. So just like inventories, the numbers will now reverse in the coming quarters as tariff front running ends and is reversed. So there's two ways to look at this report. One is you could, be scared and say, okay, a recession is here, and things are getting worse, which is not a bad thesis to have, because we know since 2022, 2023 that there are cracks in the economy, and it just takes a push and a catalyst for the economy to be sent into a recession. No doubt, we are heading towards there. However, this report, due to all the trade wars and the tariffs and whatnot, and what we've seen with Trump in the beginning of the year, the imports being the biggest component is what's dragging the GDP numbers lower. When you look at the other components, it's not that bad, right? The investment component, okay, the personal consumption's all right, whatever. Government spending as well, contraction there. But now we've heard and we've seen Trump kind of roll back, and basically he's given a pause and is kind of just cautious here, right? And we could see a reverse in those numbers, or those numbers get better in the future, especially if this trade war subsides and it gets better, right? So this initial reaction, you could argue, was due to all this trade wars, due to the imports component offsetting all the other ones, like consumer spending, investment, government, and exports, right? So you could look at it in a positive way, saying that this is a one-off, just the imports, and now that things are getting better, the numbers are getting better, and it not necessarily mean that things are going to crash tomorrow. So there's two ways to look at that. Now, the third one, the wrench in all of this, which I would focus on and see, even though, some of these numbers tend to be lagging, what you want to focus on are those jobs number. So putting this GDP number aside, saying that, okay, let's just wait till, the next coming months and see how that plays out. What's more alarming is that ADP non-farm employment change coming at 62,000, right? Versus the expectation of 114,000. And the previous number was revised lower also from 155 to 147, telling you the job market environment is not that positive. And we're seeing cracks and signs of weakness in the job market there. So what I want to see is, will we see a continuation of trend of jobs data get worse off? Regardless of, you get the a positive GDP number in the next quarter or not, right? By next quarter, could we see a negative number in the employment section? And if that's the case, then we can expect jobs are getting worse off, which is going to translate into a worse number for the GDP component, right? Not only we got that, we also see the inflation, the PCE number, the Fed's favorite number, that is higher than expected. And with a lot of imports coming in and backlogs as well, and this trade war that happened and that's ongoing, could we see also inflation get worse off in the coming months, right? Especially with the PCE number. So that is also something to watch out for. So that gives that stagflation environment where you're getting weakness in growth and inflation higher, something that the markets don't like. Now, it's noon and we've seen somewhat of a rebound in the equity markets. And it could be due to this concept of what I just explained, the imports being the reason, and that the fact that, Trump has slowed down and is sounding more softer and being more positive, that markets are forward thinking and they may think, okay, the next coming numbers may be better. This is just whatever the first quarter of Trump's craziness, and we could see things get better going forward, especially if Trump remains soft as he is, right? Then nothing to worry, buy the dip, right? Thus, what we're seeing right now in the equity markets. We'll see what happens at the close. Do we close higher or lower? That will be a telling sign. After those numbers, we also did get the Chicago PMI, giving you a signal of the health of the economy. Another indicator there coming at 44.6 versus the 45.9. Came in worse than expected, but not that bad when you compare the consensus. It's still not good also because it's below 50. It does show a sign of contraction, but just today, all these numbers, the growth story is telling you in America that things are getting weaker, and you're seeing that in the jobs and the Chicago PMI. If you want to take the GDP numbers seriously, consider it or not, you can also add that and say that is a very negative signal as well. If not, you could say, okay, I'm going to wait till we see how this trade talks plays out, and if they end up playing out positive, then these numbers could be revised better, and could see changes more on the positive side. But what I don't like is the jobs number and that Chicago PMI still showing the weakness, right? And that is going to be a telling story. Remember, the Fed has a dual mandate. They care about inflation and they care about jobs, right? So if inflation is getting hotter and jobs are getting weaker, this will make it very tough for the Fed to cut interest rates. And if the employment side gets too bad, it is possible that they could alleviate some pain and cut rates. But then if inflation is still up, they have a mandate there and they could hike rates again aggressively, right? Like we've seen previously. So very tough situation for the Fed. Negative numbers for GDP and the employment. Although we still want to see the next numbers coming out, the next quarter, how it plays out. And it's going to be very crucial to see how this trade war ends up playing out. Are we in transition period like Trump told us? Are things going to get better from now and forward? Let's see. It's really going to be dependent on what Trump does. And if he doesn't and things get worse off, then yes, you could see numbers get worse off and more tantrums in the stock market. Anyways, let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified of the next video, and I'll see you guys around. Cheers. Bye.